Hello, my good students. Welcome to our segment today. I am instructor 𝐃𝐢𝐠𝐢𝐭𝐚𝐥 and I teach Advanced Management Accounting at mDarasa Digital College. Today's session, I want us to jump straight to a concept to do with pricing and decision making, and I want us to handle a question which was tested in August 2025. Question number 1A. So these are questions that I want us to look at right now. So, of course, those who are interested in this paper, you can request Mwalimu will share this paper. So, this question was tested in August 2025, question number 1, specifically part B of the question. So, looking at the concept to do with planning and decision-making techniques, specifically, we want to look at decision-making environment under which we normally tend to make our decisions. Anytime you talk about environment of making our decisions, we normally tend to look at three main environments. This is environment of certainty. This is environment of certainty. We normally tend to talk about environment of uncertainty. And of course, we normally tend to look at the environment of risks. So these are the three environments within which we normally tend to make our decisions. The first environment, you find that everything is known. Our case is to just pick the best alternative because everything in that market or environment is literally known. When you are looking at environment of uncertainty, you will realize that at this environment, we cannot establish anything. Literally, we are kind of we don't have any information regarding this environment at all, and at the same time you cannot as well allocate probability, so we'll just be left with a decision whereby we'll be making decision based on observation, and in this case we have to establish the payoffs. Whereas when it comes to the matters of risk, you'll find that at this point we don't know of course what will happen, but what we can do, we can attach probabilities on our states, probably because of past experiences. So these are the main environments within which we normally tend to make our decision. So that's the first thing that we need to understand. The other element that will also be important for us here to note is that what are the methods that we normally tend to look at? Because certainty, environment and certainty, everything is known. Our task is just to pick the best alternative. Allow us to analyze these two environments. The methods that you normally consider under number 1, environment of uncertainty. So when you're looking at environment of uncertainty, we have this method that you must always tend to consider. Number 1, we normally tend to talk about a method known as what? Max decision rule. We have max-min decision rule. We talk about key element that we normally refer to as minimax decision rule, which also we normally take it as what? Regret. These are regret. We also talk about Laplace decision rule. Laplace decision rule. There is this element that we normally refer to as what? 𝐾𝐢𝐠 decision rule. So these are the 5 main methods that we normally tend to look at under environment of uncertainty. And in this environment, what we should be able to know is that at this point, we will be dealing with the aspect of payoffs. And when Mwalimu is talking about payoff, I'll take you back to the component of profit. How do you normally determine your profit? Talk about contribution margin times quantity minus fixed cost. That is what will give us our profit. And at this point, therefore, we'll be required to determine the aspect of payoff. Key elements to identify here would be for you to be able to identify state of nature. You don't have control over the state of nature. And number 2, you also be required to identify decision alternative. You have control over the decision alternative. So majorly your decision will always be based on the alternatives available, meaning that you can control decision alternative, but you cannot control state of nature. Then we have risks. So the methods that we normally tend to use under the environment of risk, number one, we normally tend to talk about this key element that we normally refer to as what? Aspect of expected value. See? Expected value is a very key element that we should always be able to note. Then number two, we normally tend to talk about what we normally refer to as what? Expected opportunity loss. Expected opportunity loss, EOL, which at this point it is important to note that EOL has a direct relationship with what? Minimax rate rate. It has a direct relationship with minimax rate rate. So whatever that we'll be establishing in minimax rate rate is the component that will just be attaching probability on. But the concept here is just the same, of which Mwalimu had guided us this in class. So today's session, we are looking at this question which was tested in August 2025, question number 1B. So that is what I want us to analyze. That is what I want us to analyze. So these are what you are given, these are what you are told. That 𝐤𝐧𝐨 Limited is a company that specializes in the production of umbrellas. For the year ending 31st December 2026, the company is planning to produce special promotional umbrellas branded Jumbo. 𝐤𝐧𝐨 Limited wishes to determine the optimal number of umbrellas that should be produced. See, so we need to determine. You see, we need to determine. So then this is to say that we are talking about key element of what? Decision alternative. What is our decision? Additional information number one, we're told if all the umbrellas are sold within the years 2026, they will be sold at 900 shillings each. Actually, what I want us to do is to summarize this question as we read it through. Okay, so that is to say, allow Mwalimu to erase this point. I'll just erase this point so that whatever that we'll be doing here, we'll be analyzing this question as we do it, as we proceed. We'll be analyzing the question as we proceed. And that's what I want us to do right now. Okay, that is what I want us to do right now. So what are we going to do? We start by additional information with one. We're told that selling price is 900 shillings. With a lot of confidence, you come and have selling price. If we sell it during that period, you're given what? 900 shillings. If the company is unable to sell the umbrella within the year 2026, then it will be sold in the following year at 300 shillings per umbrella. So I'm having another selling price. This is for next year, NY, not New York, but next year. So you're having a value of 300 shillings. Note 3, the production cost of umbrella amounts to 400 shillings. So we have a variable cost. Production cost, remember that is the same as what? VC, where we're given a value of what? 400 shillings. The demand for the umbrellas depends on the performance of the economy, which is highly unpredictable. So the following are the possible states of the economy which you are given. So in this case, we're given the states of economy, which we have in good, of course, average and poor. 𝐤𝐧𝐨 Limited has to decide to produce the umbrellas at one of the states of the economy in order to match forecast demand. So already there the examiner is giving us a clue that at any given point in time, my decision will be based on the demand. The production decision will be based on our demand. Then we're told, note 7, the opportunity cost of not selling an umbrella. In the event that I'm not selling an umbrella, therefore, my opportunity cost, that is the cost I'm going to incur, I'll be having what? 100 shillings. Given our variables there. So, required, we are told to construct a payoff table showing the possible outcomes. We're supposed to advise the management of 𝐤𝐧𝐨 Limited on the optimal level of production based on the expected value, maximax, and max min criteria. So that is what the good examiner is giving us here. So, by the fact that you know very well that I will be required to consider my payoff to be the concept of profit. And recall profit, we read about C and Q minus fixed costs. and CM simply is our contribution margin. So I want us to determine, in this case, I want us to determine at a selling price of 900, what will be a contribution margin. So my CM at a selling price of 900, at a selling price of 300. So if I told you a stock of 900, therefore I'll be having 900 minus 400, which will give us what? 500. That will be our contribution margin in that context, if my selling price is 900. If our selling price is 300, we less our variable cost of 400, therefore we are going to talk about a contribution loss of what? Negative 100. That is a contribution loss. That is, my first selling price 900, variable cost is 400, I'll be having 500. 900 minus 400. In this context, this is our selling price 300, and the variable cost, remember, will not change. So therefore I'll be having what? 100. If I told you to look at the state of nature and our demand, let us see. We are just doing analysis. So we have three states of nature: good, average, and poor. These are the state of nature given. If at good, my production will be 500,000. At average, my production will be 350,000. At poor, my production will be 300,000 as per what you are given there. You see? So once we have established this, we have a basis of working it out. Remember, our decision is supposed to be based on this demand level. So we need to look at each and every scenario of our production. If we produce 500, if we produce 350, and if we produce 300, what will be our case? So we start with the scenario number one. We take our production here to be 500,000 units. This is scenario one. My production to be 500,000 units. How many states are we looking? We are looking at three states: good, average, and poor. And you know, at good, my units is 500 demand. At average, demand is 350. At poor, demand is 300. See? So we need to determine our payoff at each state. We need to determine our payoff at each state. So that is to say, my first state, I need to take CMQ. My contribution, of course, we've determined to be 500. So I'll be having my 500 contribution margin times what is the quantity demand at that level. The quantity demanded at that level is 500, and I am producing 500. So we have enough to sell. So that is to say, I'll be having 500. The question is, were we given our fixed cost? That is what we need to establish and determine. Let us see. Determine if at all you're given our fixed cost in this case. In our case, we can see we aren't given fixed cost at any given point in time. Yeah? We are not given fixed cost at any given point and time. So therefore, what we are going to say in this context, I don't have our fixed cost. So what will we be having at this demand level, state of nature good? 500 by our contribution margin, which is 500. So we should be talking about 250,000. So therefore, I'm having 250,000, my payoff at the first state. The other state, what will we be having? The other state, my good students, we are looking at, the other state you're looking at, of course, 350. See? We're looking at 350. That is the state that we are considering. That is the state that we are looking at, 350. My question will be, At this point, how many units are we producing? We are producing 500,000 units. These are the number of units that you are producing. 500,000 units. So I'm having my contribution, which is 500. Yes. My demand level, whatever that is required in the market, it is only 350. You see? So I'm having excess. We produce 500, but I'm only selling 350. So what will you be having as excess? Excess will be 500 minus 350, which will give us 150. This 150, we are going to sell next year. And if we sell in the next period, we will be selling it at a contribution loss of what? Minus 100,000. So minus 100, not 100,000, but minus 100. So therefore, we'll be having here, we add. So we simply add. We come and add. See? Minus 100 times the units that you're selling next year, which is 150. I've just taken my values into thousands, so which is 150. So therefore, what will you be having in this context, my good students? We have contribution margin for that year, 500,000, or rather 500 times 350. We are going to add minus 100 times 150, which will give us a value of 160,000. That's what Mwalimu is getting, 160,000. So I am achieving 160,000. We go to the next element here. The next component here, we are looking at demand level of 300,000. So I take my contribution margin, 500, times what we are selling, 300. That is to say, I'll be having excess units to sell next year. The excess units that I'll be selling next year, I'll be incurring, or rather I'll be having a contribution loss of my 100 times, in this context, we'll be looking at what? 200. We'll be looking at 200. You can literally confirm. So that in this context, therefore, I'll be having 500 by 300. We add minus 100 times 200, which will give us a value of 130,000. Mwalimu is getting 130,000. You can confirm on your end. But this is what I'm getting, 130,000. So we have a first payoff in our first scenario. We proceed to the second scenario. If our production in this context is 350,000, what would be the resultant output in terms of our payoffs? So the same component, we're going to start, we're looking at good, average, poor. Good, 500, average, 350, poor, 300. See? So that as at the end of the day, my contribution margin will not change, 500, 500, 500. But remember, at this case, we are only producing 350,000. So the first demand level is 500,000. I only have 350. We cannot sell what we don't have. Because we cannot sell what we don't have, we only sell the available items in store, which is 350. In this case, I am going to disappoint some clients. The clients that you are going to disappoint, because my demand is 500 and I'm only having 350, so we have 150 somewhere that you're going to disappoint our clients. So we less the opportunity cost. The opportunity cost per unit we had analyzed, it was 100 shillings. So we less 100 times the number of units that you're disappointing our clients, which is what? 150. Which is 150. So then we can agree and say that I'll be having 500 by 300 here, 500 by 350, 500 by 350, we less the opportunity loss, which is 100 by 150. See, by 150. So that in this case, we will agree that I'll be having a value of what? 160,000. So you come and take 160,000 at that point. We check the other item. At average, my demand is 350, we are producing 350. So then that is to say, I don't have what? I don't have excess. Or in this case, I'm not disappointing any clients. So then we will be taking our value here to be, of course, 500 by 350, which I'm getting 175,000. So we have 175,000 because we are producing 350 and we are selling 350. We go to the next demand level, which is 500, or rather which is at 300,000. So I am producing 350 and the demand is only 300. So I'll only sell what is demanded, 300. This will give us with excess units which we need to sell next year. So the excess units that are required to sell next year, we're going to add. If at all I was to sell next year, I'm going to have a contribution loss of 100. We multiply by how many units? Of course, in this case, you're looking at 50 units because my production is 350. So there is excess units of 50 that you're going to have. That is to say, at that point, my payoff therefore would be 500 times 300. We add, in this context, minus 100 times 50. So that Mwalimu here is getting 145,000. Kindly confirm. Kindly confirm if we are achieving the same value with Mwalimu. So I'm getting 145,000. At this point, is there any question where you feel like Mwalimu, I need an explanation here and here? This is the best time to ask. Where you feel you need an explanation somewhere, this is the best time to ask. Whatever that we are establishing simply at the payoff and just the analysis that we've done. Okay. Taking us to the next element here. We want to consider, in this case, if our production now is, in this case, we are looking at our production being 300,000. See, our production being 300,000. So what will we be having if our production is 300,000? So what if our production in this context is 300,000 units? What would be our outcome? What will be our outcome? That is what we need to establish. Similar concept will apply. Actually, this case you can do it by yourself, but you can say Mwalimu, maliza kazi yako umeanza. Right? So this is what we're going to do. The same case will apply. We're looking at G, we're looking at average, and we're looking at poor. So this is 500, this is 350, and this is 300 here. See? So that as at the end of the day, what will we be having? As at the end of the day, we will be talking about my contribution which will not change. Contribution margin. This time around, you're producing 300. Our demand is 500. So I'll only produce what we have. I'm disappointing some clients because I don't have enough. And the client's disappointment, really about 200 here. That is following the steps. Really about a contribution or opportunity lost because you are disappointing clients. So opportunity loss was 100,000, yeah? So you take 100,000 by the number of disappointments, 200. The number of disappointments, which is 200, because demand is 500 and I only have 300 in store. So then we take 500 by 300, we less, of course, 100 by 200. In this context, Mwalimu is getting 130,000, you can confirm. So I'm getting 130,000 here. The other point, I am producing 300 units and my demand is 350. I can only sell what I have. So therefore, again, you're having disappointments. Disappointments in this case of 100, but this time round, the number of clients that you're disappointing are for 50 units. Because remember, we're looking at what? 350 production. And in this case, if I told you can check our demand, production is 300, our demand is 350. So therefore, we're disappointing what? 50. So then we should be really about 500 by 300, we less 100 by 50, which in this context, I'm getting a value of 145,000. So we have 145. The other item at this state, 500 contribution margin, my demand is 300 and I'm producing 300. So in this context, I won't be having either disappointments nor excess. So that eventually we'll talk about 500 by 300 to give us 150,000. See? So these are the possible outcomes that I can have, of course, in each state. So to do a summary of this is really about what? Our payoff table now. Payoff table is simply now a summary of whatever that we've done here. Where my summary in this case, if I told you to build our summary, I'll try to squeeze it here. We have this state, which is good. We have this state, which is average. And you have this state, which is poor. See? So we're about probability. We're looking at 500 production, 350 production, and 300 production. So because we have prepared our summary or our items here, so we start with at 500 production, I'm having 250,000. We have 160,000. So let me just squeeze in here. So we have good, average, and poor, whatever that we established, right? So at average, we have 160,000. And we have 130,000. We got 350, we have 160,000. We have 175,000. We have 145,000. At 300, we have 130,000. We have 145,000. And we have 150,000. See? So this is the summary of our pay, the summary of our returns. And this is now what we're referring to as what? As our payoff. This is what we're referring to as our payoff, which is very important to note. Very, very important to note. You see? So that is the first procedure. Let us incorporate probabilities. If we check our probabilities in this context, my probability at good, we have 0.3, 0.46, and 0.24. These are the probabilities that you're given. See? So, my good students, if I told you to ask for payoff, then this is our payoff table. You see, just a summary, step by step process. Step by step process. Understanding it right, then you find that everything will just be very okay. You can do that analysis. Look at that. Where you feel you're having a question, of course, there's a comment section there. You can always ask a question. Where you feel you're having a question, this is the best time to ask, of course. So once this has been established, let us look. What will we ask next? The next item that you asked, you're told, construct a payoff showing all the possible outcomes. So you constructed the payoff. Advise the management of 𝐬𝐧𝐶 Limited on the optimal level of production based on the expected value, max min criteria. So we start with the expected value. Allow me to raise this because we are done with literally all this. So we need to advise the company, of course, based on whatever that you ask there, expected value. So let us start by the expected value, whatever that you asked. So starting with the expected value, expected value, my good students, is simply the average of our payoffs. And in this case, you are going to take the decision alternative with the highest expected value. Our decision alternatives were our production. See, these were simply our decision alternative, production. So we start with the first item. If my production is 500, production of 500, what will be our expected value? Expected value therefore will be having a value of 250,000. We multiply by probability 0.3. We add 160,000 by probability 0.46. We add 130,000 times probability 0.24. We come and take, if my production is 350, what will we be having? I should be talking of 160,000 times 0.3. We add 175,000 by 0.46. We add 145,000 by 0.24. See? We go to the next item. If our production level here is 300, the same outcome or process we take. We have 130,000, so 130 by 0.3. We add 145 by 0.46. We add 150,000 by 0.24. See? So what will be your expected outcomes? We start by considering the first case, 250 by 0.3. Do it, Mwalimu, kindly. 160 by 0.46. 130 by 0.24. In this context, Mwalimu is determining 179,800. So the first case, I'm having 179,800. Kindly confirm. We are doing about 160 by 0.3. We have 175 by 0.46. We have 145 by 0.24. So that as at the end of the day, we're going to talk about 163,300. 163,300. See? Then lastly, we are talking about the other case, production level of 300. So we have a value of 130 by 0.3, 145 by 0.46, 150 by 0.24. See? So that as at the end of the day, we are establishing 141,700. So if I told you to make a decision, my good students, which production level will give you the maximum average payoff? In this case, we can advise the company, if at all they're using expected value, to go with what? Production of 500,000 units. This is where you can see we are having what? The highest payoff. We are having the highest payoff. See? So that's the first thing that we need to do. The other method, what are we asked? Look at this case. We are asked to work out the component of what? Advise the management of 𝐤𝐧𝐶 on maximax and maximin criteria. So maximax criteria, what are we going to do? This is what we need to do. We have to look at maximax. So we identify the maximum payoff under each decision alternative. So the maximum payoff under each decision alternative at 500 maximum is 250. At 350, we can see maximum is 175. At 300, we can see maximum is 150. So we take the best of the maximum. The best of the maximum, we can see here we have in what? 250. So if at all I was to use maximax decision rule, if we were to use maximax decision rule, maximax, therefore the decision alternative would be to produce 500,000 units, because that is where we are maximizing our payoff. That is where my payoff is the best of the maximum. The best of the maximum payoff we will achieve 250,000. See? So decision will be to produce 500,000. Maximin. Maximin, what we'll be required to do is first of all to identify the minimums. Come and identify the minimum under each decision alternative. So minimum at 500, we have 130,000. Minimum at 350, we have 145. Minimum at 300, we have 130. So we are required to take the best of the max, the best of the minimums. And the best of the minimums here, I can see it is what? 145,000. So then, if I told you to advise based on maximin, if I told you to advise based on maximin, production level of how many units? 350,000. Where the best of the minimum payoffs, the best of the minimum payoffs, you can see it is what? 145,000. See? So this is what you are required to do in this question. This is what you are required to do in this question, which you can clearly see we followed the exact steps that Mwalimu gave us on the coursework. And if at all you've not managed to check the coursework, kindly go and check the coursework in our platform, app.mdarasa.com. Go to the platform, check the coursework, app.mdarasa.com. We have a very beautiful videos that we've created for you, which you can all go through this coursework. And for those who are doing advanced management accounting, this semester is the best semester to join mDarasa Digital College. And in that case, of course, you can always reach us out on 0708 068 851, or just log into app.mdarasa.com. Mwalimu here will personally take you through advanced management accounting. For those who are joining the semester's classes, remember we are commencing on the 1st of September. 1st of September. So this point, I believe you've learned something. So see you guys in our next class as we continue learning advanced management accounting. Thank you so much. See you on the other side. Bye-bye.